If you're looking to invest in stocks, then it is absolutely critical that you properly understand how to analyze a company that you're interested in so that you know whether or not you're looking at a good opportunity or if you're looking at a stock that might underperform, leaving you wondering what went wrong with your stock pick. If you've had the chance to watch any of my recent Q1 earnings analysis videos where we covered companies like Air Canada, RioCan, Lightspeed, etc., then it's safe to say that you're well aware of the fact that analyzing each individual company comes with its own set of challenges and touch points because you simply can't analyze each company in the same manner, especially if they operate in different industries and have different business models. So for this reason, it can be extremely difficult and confusing to paint yourself a clear picture of whether or not you're overpaying for a stock because each individual company has hundreds of different data points that analysts take into consideration when determining whether or not the stock is a buy. Even more, why do some stocks cost $50 per share while others are costing north of $1,000 per share? Does this actually mean that you're paying 20 times more for that stock? And how do you know if a stock is overpriced or undervalued? These are questions I get asked all the time, and unfortunately, it's not as simple as saying that a stock that's trading at $100 per share is relatively more expensive than a stock trading at $50 per share. However, there is a way that investors can gauge whether or not they are overpaying or underpaying for an asset relative to its historical performance and the performance of other companies in the same industry with something called multiples, which is what we're going to be speaking about in today's video. Hey, what's going on, savers and investors? I hope you're all having a great day as always and that you're getting ready for the weekend. Over here in Ottawa, at least, it is absolutely insane. The weather is like 30 degrees with a humidex of 40, just absolutely disgusting. But nonetheless, if you're new to the channel, then welcome. My name's Griffin, and in today's video, we're going to be taking a quick break from the Q1 earnings analysis videos to talk about stock multiples. Now, I know the Q1 earnings analysis videos are highly enjoyed, and for this reason, I have a bunch more in the works of companies that you've all requested. But in today's video, stock multiples, it's come to my attention that a lot of viewers don't necessarily know what they are and ultimately what they mean. After all, the whole point of this channel is, yes, for you to get my take on different stocks, investments, and personal finance topics, but ultimately the goal of my channel is to help you understand what the heck you're looking at when analyzing a stock on your own. So for this reason, in today's video, we're going to be focusing on the price to earnings ratio, also known as the PE ratio, because this is by far the most commonly used and widespread stock multiple. Now, when most people are interested in learning about a new stock, myself included, the natural thing to do is search for the name of the stock in Google with the word stock at the end, which brings up what's known as the stock quote, where you're presented with a bunch of information related to the stock's price over time, dividend yield, market capitalization, and also the PE, which is the company's price to earnings ratio. If you're a new investor, it's extremely common to be wrongfully fooled by simply looking at the stock price of a company and determining if it's expensive or not based on the share price alone. Just because dropping $1,500 on a stock might be a lot of money to dish out in contrast to a stock trading at, say, $50 per share, this doesn't mean that the $50 stock is a cheaper asset relative to its underlying fundamentals. This is where multiples come into play and allow you to obtain more of a level playing field when assessing a stock. The price to earnings ratio, or PE, is by far the most commonly used and widely recognized stock multiple, which allows investors to quickly get a sense of how relatively expensive or relatively cheap the stock is compared to similar companies based on their earnings. The price to earnings ratio divides the stock's current market price by the net earnings of the company, but we'll get into more detail about comparing PEs of similar companies for proper assessment later on in the video. There are dozens of different stock multiples that investors and stock analysts use in order to determine where opportunities lie in the stock market, each one typically dividing the current market price per share of the asset by a specific item in the financial statements of the company. This way, when comparing two price to earnings ratios of different companies, for example, you can get a quick idea of the relative value of each company in relation to each other based on an underlying fundamental, which in this case is the net earnings of the company. In general, a higher stock multiple, in this case the PE, means that the stock is trading at a more expensive price point relative to the underlying financial fundamental for which the current market price is being compared to. In the case of the PE, it is the net earnings of the company. In contrast, a lower price to earnings ratio indicates that the stock is trading at a cheaper price point relative to that underlying financial fundamental. Keep in mind that different industries will have average price to earnings ratio that differ, with some as low as 10x as the average and others like the tech industry that can be in the 20x range. Calculating the PE ratio is very simple and comes down to dividing the current market price of the stock by the earnings per share of the company. For example, with the company of Fortis Incorporated, which is a utilities company up here in Canada, well, this company has 464,300,000 shares outstanding and an earnings figure of 1.722 billion in the last 12 months of operations. Well, we can calculate the earnings per share by dividing the earnings with the outstanding shares, giving us an EPS of 3.71. When then dividing this earnings per share figure by the market price of the stock, we're left with the PE ratio of 14.38, which is exactly in line with the PE in the stock quote. This PE, based on the past 12 months of earnings, is also known as the trailing 12 months PE. That is the most commonly used form of price to earnings and is abbreviated to the TTM PE for trailing 12 months price to earnings. The reason why this is the most commonly used type of PE variation is because it is based off of the historical earnings figures for the past 12 months that are real and documented, in contrast to, say, the forward PE, which takes into account the forward earnings guidance for the company rather than the trailing figures, but we'll be diving into the forward PE shortly. Let's take a look at an example to illustrate what we're speaking about in regards to comparing the value of two companies based on the PE ratio. So when comparing Fortis and Canada Utilities, it's difficult to say just how cheap or expensive each stock is relative to the underlying financials simply by looking at the price per share. The first company is trading at $53.35, while the other is trading at $33.07, but we can use the PE ratio to determine which one is relatively cheaper than the other based on the earnings for the past 12 months, and this is a valid comparison since both companies operate in the same industry and offer relatively similar products. In this example, Fortis Incorporated has a PE of 14.38, while Canada Utilities has a PE of 10.91. This means that if you were to purchase shares of Fortis, you would be paying more right now for the company's relative earnings than with Canada Utilities. Okay, great. So we now understand why the price to earnings ratio can help investors quickly determine whether or not a stock is trading at a fair price point. But ultimately, what does a PE of, say, 30x even mean in relation to the financial fundamental of the company? The price to earnings figure pretty much represents what an investor is willing to pay for their share of the profits or earnings of the company. With the example of Google, their trailing 12 months price to earnings ratio is 28.58. So in this example, it means that you're willing to buy shares of Google at 28.58 times your share of the company's profits. In other words, it would theoretically take 28.58 years for you to make your money back on your investment based on the earnings of the company. Now, again, the reason why the trailing 12 months PE is the most commonly used and widely accepted is because it's the most objective due to the fact that it's based on real concrete data from the company over the past 12 months of operations. However, this form of PE could be somewhat misleading in regards to the upcoming earnings of the company in the next calendar year if, for example, the company is focusing on launching new products or launching into a new market. This could dramatically boost earnings and therefore have an impact on the forward price to earnings. This is where the forward price to earnings ratio comes into play and can help investors determine whether or not the forecasted guidance of earnings over the next 12 months of operations for a company will render the current market price overvalued or overpriced relative to those earnings figures. For example, with Google that we just looked at, their trailing 12 months price to earnings ratio is 28.58. But let's just say the company is forecasting that they're about to launch a revolutionary new product where, let's say, you're going to be able to walk through their Google Street View with some VR capabilities, just something really cool like that. And they're forecasting that this is going to up their net earnings by, let's say, 50% for the 12 months coming up. Well, considering these forecasted guidance figures for the upcoming 12 months, this would have a major impact on the current forward price to earnings ratio of Google. So as we can see, comparing this forward price to earnings ratio to the trailing 12 months price to earnings ratio can really help investors get a good idea of whether or not the current market price is attractive or not. Obviously though, making calculations based on forecasted guidance figures can be somewhat unpredictable and risky because after all, these guidance figures are not concrete concrete data that are recorded in the company's books, and this can change at any moment. A real-life example of this reality is right now with the whole medical issue, as pretty much all companies across the board have dropped their 2020 guidance figures due to the uncertainty of business operations over the course of this whole medical issue and what we're living through. Now, only a couple months back, a forward price to earnings ratio based on those forward guidance figures could have made a stock either attractive or overvalued, but now with everything thrown out the window, those forward guidance figures from back then would have rendered them pretty much non-usable. But this is just the potential danger that investors need to be aware of when using the forward price to earnings ratio in order to make investment decisions. All right, so at this point, I really hope you understand what the price to earnings ratio is, but let's say with Google at 28.58, theoretically this means that it would take you 28.58 years to make your money back in terms of the earnings of the company for your share of the company. But with all that said, what does this exactly mean in the big picture when analyzing a stock? Because alone, this figure of 28.58 doesn't really give us all that much information. You need to remember that stock multiples, with the price to earnings being included in this, are basically tools that will allow you as an investor to do a comparison of this current price to earnings, let's say the 28.58 figure of Google, to other peers in the industry or itself over time historically. One of the most common ways to utilize the price to earnings ratio is to compare the current price to earnings for, let's say, the trailing 12 months of a company to its historical 10-year price to earnings average to see how the company is faring right now in terms of the net earnings relative to the past 10 years. If the current price to earnings ratio is below the historical 10-year average price to earnings ratio for that company, this could mean that it is undervalued and could be a good opportunity to buy. On the flip side, if the current price to earnings ratio is above this average historical 10-year price to earnings for this specific company, it means that temporarily investors are willing to pay more for each dollar of earnings of the company and could mean that the stock is overvalued. With that said though, it could mean that investors are really bullish on the stock and the potential future earnings of the company, thus driving up the price and the price to earnings ratio. This is just one way to utilize the price to earnings ratio, however, and should be used in conjunction with other tools and ways to analyze a company. For example, comparing the price to earnings ratio of a specific company to other peers in the same industry. This can give you a good idea of the relative value of the stock compared to these other companies. All right, great. So you're now fully up to speed with what the price to earnings ratio is, how it works, how you can calculate it, and how you can use it to assess whether or not a stock is cheap or overvalued relative to itself historically and other companies in the same industry. When you now take this new learned information and then apply it to assessing a stock or a company, it's still really important that you only use the price to earnings ratio or another relevant multiple as one single data point in your overall assessment of the company and stock. As I do in my Q1 earnings analysis videos, for example, the price to earnings ratio is still really important, but is only one single element in the global picture, where I also assess the earnings statement, the balance sheet, cash flow, and other forward-looking information. If you personally want to see how I go about doing a full assessment of a company's earnings and basically their overall operations, then make sure you check out one of my Q1 earnings analysis videos. Always keep in mind that just because a stock is trading under its historical price to earnings ratio or under the industry average does not necessarily make it a buy that's worth pursuing, even if it's considered a cheap stock. This is because a cheap price to earnings ratio could very well signal an undervalued stock and a good opportunity to buy, but it could also signal underlying fundamental issues with the company's financials or other external factors that are expected to have a negative impact on the operations and earnings of the company in the near future. The reality is that the stock market can be an extremely volatile place, as we've experienced over the past couple of months of trading, and oftentimes investors and traders will price in emotions, speculation, and unfound logic into the price of stocks, which is reflected into the stock multiples. For this reason, always properly assess the stock you're interested in's future earnings growth potential and determine whether or not you are comfortable paying a certain multiple for the company's earnings right now. For some companies like hypergrowth tech stocks, Shopify and Lightspeed come to mind for me because I just looked at them and did Q1 earnings analysis videos on them. These companies don't even have price to earnings ratios because they aren't yet get profitable. So theoretically, you're buying shares at an unlimited multiple of their earnings, which from a value investing point of view would not be a wise decision. With that said though, these types of stocks are for the time being only going to provide investors with huge potentials for capital gains, and that's really the reason why investors are willing to take on that added level of risk even if the company isn't profitable. For this reason, and depending on what you're after as an investor and what you're comfortable with, the price to earnings ratio might not be a data point that you want to take into consideration in your overall assessment of the company, because the price to earnings ratio might either be non-existent or it might be something like 50 times earnings, but nonetheless, this doesn't mean that the company doesn't have potential for huge capital gains in the medium to short term. The point I'm really trying to make here is that stock multiples can be a really great starting point for an assessment of a stock and comparing it to itself historically and other companies in the same industry. However, it's really important that you take the price to earnings ratio or other multiples with a grain of salt and really only use them as one data point in your overall assessment of the company. If this video was helpful in allowing you to better understand what the price to earnings ratio is and what stock multiples are, then please make sure to smash the like button. It really helps my channel grow and reach a wider audience. And if you're interested in learning more about stock market investing and other personal finance topics, then make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release a new piece of content. On that note, thanks a lot for watching as always, and I'll see you in the next video.